Good day to everyone. Jacob Chaparro here alongside my colleague Pablo Marul. First off, we want to wish everyone a happy new year. Hope you guys had a safe and fun end of the year. We're wishing everyone here, of course, a very prosperous and healthy 2022. Pablo, how's it going?
Hey Jacob, how are you doing? Very good. We are fine here. It's a little warm in this area. Looking forward to a great 2022.
2021, we can deem it a great success from the market standpoint. So the two things that we want to do with our January market update is really recapping last year, understanding what worked, what didn't work from a performance standpoint, what investments did well, which ones exceeded, which ones underperformed, and just finish off by giving you some outlook, a blueprint as to what we think can transpire throughout the year. So we want to spend the next 10 or so minutes giving you an idea of what that looks like here. So Pablo, why don't we start before we look at our outlook for this year? Many risks out on the table, the Fed hiking, inflation reading at a 39-year high. What else do we have? Supply chain issues. We have midterm elections this year. There's a lot of potential landmines here, which we can discuss here. But why don't we start with looking at how we did last year, which will give us a really good foundation as to what could potentially perform well this year.
Totally. Well, it's always important for our listeners what happened last year and to do some an historical. Basically, the indices, the most popular is the Standard of Poor's 500. The return for last year, it was 28%. When you had the Dow Jones, that was around 20%. And then the Nasdaq 27. So you have the Standard & Poor's 500 and the Nasdaq. Then emerging market was the worst asset class of all of them, which returned minus less than 1%. And then international, which is developed market, non-US developed market, was around 11%. So why this is important for you? Your 401k, your individual brokerage account are tied to these asset classes. So that's the reason why this is important. So then Jacob, we go to sectors. The best sector was energy. And energy, when we say energy, is companies like Chevron, ExxonMobil. So companies that they have, overall, the sector returned 53%. Amazing, no? What happened in 2021. Then you have real estate, top performing around 46%, and financial like JP Morgan, Goldman Sachs, American Express, Wells Fargo, companies that they are well known. The worst sector in 2021, it was communications, which you have there Facebook, Google, Disney, and staples and utilities. Well, worse in quotes, no, because staple returned 17% and utilities 17%, but relative to energy, it was the return less, basically.
It was drastic, yeah. And before we go into bond, you look at these numbers and they look amazing, right? So one of the challenges that I think us, including a lot of people, investors and money managers ran into is those that invested in the indices above, will show it again in the S&P, benefited a lot, and a diversified portfolio didn't get as much return. And when we look at bonds, we'll look as to why. But that's one of the things that we always want to focus on is the risk with valuations being at what they are. There's always this rotation into other types of investments that we want to get first glimpse on, right? Overall, fantastic year, right, Pablo? When we look at how the general indices perform, with the exception of emerging markets, a lot of opportunity out there last year.
Totally. And what this is what you say is very important, and everyone has to know that in many cases the return came in the first 3 months, like energy, like a small cap.
Super key.
So, and even though well, in technology was different, no, but it was a very tricky year. It's true, when we see this return, it's like, wow, amazing. Yes, not all is depending on when you bought it, you know.
And I love that. Not to get too deep into this, but out of the 52 weeks last year, the majority of the gains came in the first 10 weeks of the year, basically January through early March. and then the last 3 weeks of the year. And I want to make sure we pause and acknowledge that to stay invested throughout is super critical so that we can make sure that we're capturing the moment of windows, those windows of time. Because if you segregate per quarter, summer was very tough. Q2, Q3 of last year. So it's an excellent point, which we'll come back to when we look at our outlook for next year. But I'm glad you said that, Pablo, because not all gains are treated equal, right? At the end.
Totally. Making echo what you just say, when we analyze bonds, for instance, like you're saying, a diversified portfolio has a component of the portfolio that is in bonds, no? And for instance, the Barclay aggregate index was a negative return of 1.6%. Investment grade, it was a negative 1.6%. And the only two positive were high yield bonds, which they tend to correlate with equity, so they do 4% up, and then US tips, which the return was 6%. Long duration bonds, it was negative as well. So that's kind of what is telling you what happened is, interest rate went up in the first 3 months of the year, then they came down a little bit, but then they went back again. So and we were lucky that we did a good selection in the exposure to fixed income, and it was good for our clients.
Talking about an overall well-versed portfolio, thing is, if people were very, very concentrated in certain equities like the S&P 500, they're jumping for joy, right? When you look at a well-allocated, diversified portfolio, there was a drag. There was a drag because of the bonds that we looked at, with the exception of tips and high yield. What I'm trying to say is, don't get caught chasing returns. And especially coming into this year, we're already starting to see a little bit of difference in some rotation. The takeaway, especially for clients that are tuning in, is at the end of the day, we want to make sure that your return is actually meeting your goals. And across the board, we did that. What I'm saying is, after 3 straight years of 20 plus rates of return, it's very easy to want to get more and more and more. But we have to remember that at the end of the day, we want to just use the market, not follow it and chase the returns, and get it back to what your specific goals and needs and what your plan calls out for. Challenging year within its own terms. This year obviously presents challenges and good opportunities. Before we dive into that, anything else from last year's recap performance-wise, Pablo, that we want to share to our clients and listeners?
No, basically we would like to share some an outlook or some perspective for this year that is coming with, like you say at the beginning, with potential challenge. Well, after 28% return, let's not get too greedy, no?
It's easy. It's human nature, and greed comes emotion, and with emotion and trading, that typically doesn't pan out too well, which is why we emphasize stick to what your goals are, to line them up with what rate of return, you need. Let's transition into this year. So what does this year potentially bring? I think a great way to start is addressing what the big institutions think, because the matter of the fact is, a lot of these big institutions, these banks, these financial institutions do have a really, really great weighting as to what the market does. So understanding what their expectations are is a great foundational step to seeing what opportunities, what risks lie. And out of the big 10 institutions, which include companies such as Goldman Sachs, Wells Fargo, Morgan Stanley, all the big financial institutions out there, there was a recent poll, and this is done annually. Out of 10, only 2 of them thought or are forecasting that we're going to have a negative year next year. Only 2 thought that we were going to have double-digit returns, and there were no more than 15%. The consensus next year is for us to only have gains anywhere between 5 to 10%. That's important to understand, because if people are already expecting that, that typically does play true. That's a great thing to understand, what expectations big institutions, again, are looking at, because it can provide us a good roadmap as to when we should take risk, when we shouldn't. Pablo, you mentioned last year, and this is more often the case, right? When the majority of gains are made, it's typically within a matter of 12 weeks, 15 weeks out of the entire 52 weeks during the year. So in this year, we have to be very vigilant, and our room for error is not much, but you can use that as an advantage, because if we're operating under closer parameters, that should give you more focus to hopefully make good decisions here. Pablo, anything you'd like to add on that front?
Like you mentioned, we will be vigilant in how we will try to protect their value relative to the asset classes that we pick. No, definitely we cannot control the market, but at least we can diversify in order to something goes very bad, lose less than the rest. The important part is like we outline some of the potential risks that can generate maybe a 2022 that is not going to be as good as 2021.
Zenith's outlook is actually within the consensus. We do believe that we are going to be right around that 5 to 10%. There isn't a lot of scenarios through our expertise that point to having a negative year as a whole. And there isn't many scenarios through our eyes that basic double-digit 20% plus returns that we've had for multiple years now take place this year. Give you context why that is. When we look at risk, which we've talked about, the Fed's going to raise rates very likely 3 times this year. That's going to alter a lot of things, from the mortgage that you're paying to the car loan, your credit cards, to your savings account. That alters a lot. So 3 expected rate hikes will shift our economy, will shift our markets as a whole. We talked about inflation, the supply chain issues. Needless to say, these risks are always going to be out there, and we can't be fearful, but we have to be observant. Something that we've been keeping track of when we're piecing everything together in our outlook is this also is a midterm election year. And if you look at things from a historical standpoint, midterm election years tend to be a lot more volatile in comparison to other years because of the uncertainty. And when you factor in current risks, in which we already spoke about, I think it is going to be overall a volatile year. It is going to be a less fruitful year, but that doesn't mean it can't be a successful one. One thing in which we right now currently are looking at is one indicator in January that we look at is what's called the January barometer. Not to get too technical here, but I encourage you to research it, to Google it. And the saying goes, as January goes, the markets go. So in a simple way of understanding is, if we have a positive January in the general markets, it could be a really good sign as to what the year looks like. And to make this very real, this indicator, since going back to the 1950s, has a accuracy of 84%. So if you look back since 1950 and you look at what January did in the market, if it was positive, 84% of the times the year ended up being positive. Not that we're going to put all our weight in that specific indicator. I bring it up as we are into a few weeks into January. The markets are currently operating in the red. Things seem to be a lot more volatile. So maybe we do actually track history here. Pablo, any thoughts on that front?
There is something that probably is important for our investor to know, that what's happening, interest rate go up, or the Fed withdraw liquidity, that's going to affect companies that they're known as growth or technology companies in general, that they have grown in value a lot in the last 2 or 3 years. As we can see right now, there's a lot of vulnerabilities in the Nasdaq, or technology is a part important of the Standard & Poor's 500 index. So just for our investor about this, you will see in the next 2 or 3 months what is happening with the Nasdaq or technology stock. But yeah, that's it. I think that we will be very vigilant about your assets.
Yeah, well, there's definitely a plan, a vision that we have. We end our conversation with potentially how we track the first federal Fed hike is expected in March. So I think we want to be very vigilant around that time. We're experiencing volatility, but the likelihood of us having an actual correction, which we haven't had now for years, and the correction being a 10% sell-off in the S&P 500, is extremely likely. We've had it in the other general indices, such as the NASDAQ. The Dow Jones still has not. We do have a plan here and an outlook to make sure that we are modifying as we go, whatever hand we're dealt. And one of the big factors, as Pablo mentioned, we've mentioned a couple of times, is when the Fed raises rates, when they start to reduce their balance sheet. As a whole, I think we can expect a actual correction this year. We can expect a good bounce back. All things being what they are, we're still in a mid-cycle from a business full cycle. So things are still really good. People are starting to get back to work. The supply chain issues are starting to get a little bit better. I think valuations in the general stock markets, if you look in the right places, there's some good deals. Needless to say, the runway is a little shorter this year, I believe, in terms of upside, but it doesn't mean that it's a doom and gloom scenario whatsoever. The last thing I'll say is opportunity. These corrections do give someone an opportunity to make sure that we capture the wave up. And that to us is a bit exciting, right? We don't look forward to these things, but it is opportunity for us to capture some special returns, just like we did in COVID when the market crashed. So follow us for our next monthly update to see how things progress into the month of February. We thank you for our clients spending time here with us. We thank you for choosing Zenith, of course, and we look forward to another successful year here in 2022.
Perfect. Take care, and well, we will see you next month.